Hey everybody, in this video we're going to be talking about income or loss from property. Okay, so what are the major learning objectives in our module on property income? First up, the definition of property income and the ability to distinguish it from business income is going to be very important. The identification of various types of property income as well, certainly 3 or 4 major types of property income. What's the tax treatment for different types of dividends? That's pretty important going forward. Determination of net rental income for a taxpayer, rental income being a type of property income, and then the calculation of capital cost allowance and the UCC balances for rental properties.
Before we get too far into our discussion, let's just keep in mind where this chapter figures into our final calculation of net income for tax purposes. So we're focusing on a very specific component of income, and that is property income. We've learned all about employment income. So if a taxpayer had any employment income, we would add it to any business income, and now any specific property income. We could potentially also have property losses for a taxpayer. Now that's not super common, but it definitely happens, specifically with things like rental income, where you could have a rental loss for the year. So we'll talk more about that when we talk more about rental income. Well, what's property income? Property income is considered to be a return on capital, some kind of an investment, a purchase in property, where the return is generated through allowing somebody else to use your property. And this will become more clear once we actually talk about the different kinds of property. Now, the return is generally on an annual basis or a regular basis, so it's consistent. You think about something like rental income, you're generally receiving rental income once a month. You think of something like interest, you're receiving interest once a month or quarterly or annually. Something like dividends is generally received annually, but they could be received quarterly as well. Now, property income is different from business income in that it requires little or no time in order to earn that income. It's earned through what we would say is a passive process, whereas business income is earned through an active process. So generally, I mean, the formula is very straightforward, as it is for things like business income, where you have income coming in, revenues from property, something like a dividend or rental revenue, and then you're going to subtract any related expenses on that. So, for example, with property income, you'd have capital cost allowance, or you'd have repairs and maintenance on the property that you own. Now, the specific types of property income we're going to talk about include the following. Interest. Interest you receive on lending somebody money or putting money in the bank, for example. Dividends is another type of property income. Basically, dividends are paid out when you purchase, as a taxpayer, shares of a corporation. It's an annual or quarterly return. Rental income is when a taxpayer owns some real estate or some other kind of tangible property that they lend to another taxpayer and receive some kind of return on. Royalties is another specific type of property income that we'll talk about very briefly towards the end of the chapter. This does not include capital gains or losses. Capital gains or losses are when you buy some property and then you sell that property for more, hopefully, or less than you paid for it. The difference between those amounts, what you paid and what you sold it for, can be considered a capital gain depending on what it is you sell. We'll talk a lot more about that after the midterm. Property income or loss from property is determined on an annual basis. Now, for individuals, a taxation year is a calendar year, so you would be determining your property income for a taxpayer for an individual calendar year. Now, for corporations, the taxation year is defined as a fiscal period, which actually doesn't have to fall within a calendar year, but that's just kind of for your own information. This course is focused on individuals and not corporations. Just wanted to stop and take the time to remind everybody that if you were to incur a loss from property, it can actually potentially offset other sources of income, like business income. So in this example here, we have Jessica Jones, who has business income of $50,000 for the year, and she also has loss from her rental property of $20,000. How do you come up with a loss from rental property? We'll talk about it a bit, but let's say she didn't have very much revenue, but she had a lot of expenses related to that rental property. She had a lot of repairs to do for the year, for example. So she actually has a $20,000 loss. Her total net income for the year for tax purposes would be $50,000 offset by a $20,000 loss, which would give her $30,000 of net income for tax purposes. Expenses are generally deductible from property income if they are actually incurred in order to earn that property income. So they couldn't be unrelated expenses. You can't have some sort of business expense and then offset against your property income to try and reduce your property income for tax purposes. The expenses can't be capital in nature, meaning no capital or long-lived assets can be deducted. Now, you're going to see later that we can take some capital cost allowance from some different types of property. However, that's pretty limited in scope. We'll discuss it in more detail as we get to rental income. We can't deduct any personal or living expenses from property income. That's not unusual. You can't deduct personal expenses from business or employment income either, and they have to be reasonable under the circumstances. Speaking of expenses, what about interest expense? Is this deductible from property income? Well, interest is deductible to the extent that the money is borrowed to purchase investments to earn property income. Those investments could consist of a number of different types of things, such as buying shares in small Canadian companies, buying shares in a public company, buying some kind of a rental property, or buying bonds that pay interest or any other interest-earning property. So the idea behind this is if I borrowed money from the bank and I went back and bought shares in a small Canadian public company, the interest that I paid on the money that I borrowed would be deductible from any property income I received, which in the case of a small company would be dividends. Same thing with a public company. Now with rental property, it's a little easier. I go to the bank, I borrow some money, I buy myself a property. I then rent it out and earn rental income. From the rental income, I can deduct the interest expense on the money that I borrowed to buy that property. Now it's worth keeping in mind that any interest I pay on loans to purchase personal use property isn't deductible at all. And this makes sense, I hope. If I go out and buy some other property, like a car, with money that I borrowed from the bank, any interest I pay on that money that I borrowed isn't deductible because the car wasn't purchased to earn income. Hope that makes sense. All right, let's talk a little bit about rental income before we get into the CCA calculation for rental properties. Now, rental income is defined as compensation that's received for allowing some other party to use your own tangible property. Now, this is generally earned through real estate rentals, and this is probably what you're familiar with if you've ever rented before. However, you could potentially earn rental income through renting out some other piece of tangible property, equipment, machinery, I don't know, automotive, something like that. Generally, this is included like other forms of income, specifically business income, on an accrual basis, i.e. rental income is earned when the service is complete, not necessarily when it's actually received. The formula is pretty simple for rental income. Any rental revenue is used to deduct any permitted deductions from. The net of those two things is your net rental income. Okay, so what are these permitted deductions that I was talking about? Deductions you can take from your actual rental income. Well, there's a lot of them, so here we go. Any costs incurred to borrow money, such as interest expense, can potentially be deducted. Any insurance could potentially be deducted. You know, you'd have to insure your rental property, for example. Property taxes is a very common deduction if this place is owned. Any repairs and maintenance can be deducted from rental income. Any utilities, that's a fairly standard deduction. Advertising, hey, come rent my place, it's amazing. Take a look at this flyer, or take a look at my ad on the internet. Any relevant expenses there could be deducted. Any landscaping costs that you incur around a building are fully deductible from rental income. The capital cost allowance is deductible, but it does have some specific rules, and honestly, there are not that many cases in which you'd want to deduct capital cost allowance, but I'll talk about that in further slides. Any salaries and wages that you might pay to employees to maintain your rental property can possibly be deducted. Property management fees are similar to that. They can be deducted. Any accounting costs you incur, if you're paying somebody, hopefully you're the one getting paid, but if you're paying someone to do your accounting for you, then you can deduct that from any rental income. And any costs you incur to collect rents. I'm not sure what that means exactly. I assume that if somebody's not paying you and you have to hire a lawyer or maybe some hired goons to run around and, threaten your deadbeat renters who aren't paying you, perhaps those Perhaps the hired goon salaries can be deducted from your rental income. I think here we're looking at legal fees. So as mentioned, there are some specific rules surrounding CCA and rental properties that I'll get into in my delightful video that you guys can go and check out. Just to summarize, each rental property with a cost of greater than 50 grand has to be put into its own separate Class 1 pool, and rental losses can't be created or they can't be increased by deducting CCA. So if you're already looking at a rental loss, you can't increase that loss by deducting CCA. You can also not create a loss, meaning if your net rental income, for example, is at 0, you can't go ahead and create some kind of a loss by deducting your capital cost allowance for the year. Take a look at this video. The last type of property income I'll talk about is royalty income. Now, royalty income generally is defined as any payment that a taxpayer receives for the use or exploitation of artistic or literary works or patents, intangible assets, or mineral rights, things like that. Now, this is normally treated as property income if these items, literary works, patents, etc., have been purchased or they've been inherited through the death of a relative generally. Usually, the income here requires very little effort in order to achieve the revenue. You just kind of sit around and the royalty income flows in by virtue of the fact that you hold the rights to some famous book or song, something along those lines. So some examples include some trademarks or copyrights, patents, etc. Generally, like I said, this is considered property income, but there's a potential it could be considered business income if there's a lot of effort that's put in to actually earning that income. And an example of that would be a musician who writes an actual song. If you write the song, that's potentially, and in all likelihood, your business. So the income would be treated as business. You'd be able to take deductions from that accordingly. And business and property income are actually taxed a little bit differently.
So how do you best prepare yourself for what's to come in property income? Well, property income is generally a subject that students don't struggle with too badly. What you want to do is make sure that you've read through the appropriate sections in the course pack and attempted all, not some, all of the course pack problems. There are a bunch of additional videos that you can check out on D2L as well. There's various videos on interest, dividends, rental income, and a slew of others up there for you to take a look at. So, good luck out there. You got this one, guys. Hey guys, thanks for watching this video. Did you find it helpful? Well, there's plenty more videos for you. Check these ones out right up here. And if you really found this helpful and you want to be updated of all the latest videos, why not hit subscribe? It's that button right over there. Check it out, guys. See you next time.